In that, right, cost of debt, cost of debt. Now, what is cost of debt is what do I give to a debt guy? What do I give to a debt guy? And again, the definition is long-term debt. I'm not bothered about the short-term debt because it doesn't form part of my capital employed. What forms part is only long-term debt. Even in my capital budgeting, interest on short-term loan is to be subtracted. Long-term only is ignored. In FM, capital means long-term money, and long-term money means permanent money has to be there. Now, cost of debt, basic terms, you would have come across all these terms. I'm just repeating them. Coupon rate, coupon rate, coupon rate. What is the meaning of coupon rate? You could have come across this term. What is the meaning of coupon rate? Okay, right. Rate of interest payable on a debt instrument. Rate of interest payable on a debt instrument. Coupon rate is rate of interest payable on a debt instrument. Every long-term debt, if I have a debenture, you will say debenture, not name it as debenture, you'll say 12% debenture, 10% debenture, 8% debenture. There will always be a rate of interest on a debt instrument. Face value. Tell me this, at least this you should be able to tell. What is the meaning of face value? Nominal value, par value. What is the difference between face value and issue price? What is the difference in these two terms? Issue price may include premium or discount. Okay, interest, I am paying 8%. Face value 100. Issue price 120. Should I pay on 100 or 120? Interest is always paid on face value. Interest is always paid on face value. Now, write value return on the face of the instrument. Value return on the face of the instrument. Assumed as 100 if problem is silent. You can assume any number, okay? I can assume as 100, 1000, 10, that's okay, but we'll assume something if problem is silent. Issue price, price at which the instrument is issued, price at which the instrument is issued. It can be issued at par, premium or discount. Par, premium or discount. You can issue a debenture at par value, premium or discount value. Full stop. If the problem is silent, then issues at par. If the problem is silent, then issues at par. Very clear on these terms because they'll make a lot of difference when I solve it. If the problem is silent, issue will happen at par value. It will have a lot of implication later on. Redemption value. Redemption value. What's the meaning of redemption value? Value at which the company is going to buy back or company is going to repay on maturity. Amount payable by the company on maturity. Amount payable by the company on maturity. Assumed as par if the problem is silent. Redemption will be at par if the problem is silent. Interest in bracket in rupees is equal to face value into coupon rate. face value into coupon rate. Full stop. Interest is always paid on face value. Interest is always paid on face value. Interest is going to be always paid on face value. Clear? Interest after tax. Interest after tax. Now the concept is interest, whatever I pay, I get tax benefit on that. I get tax benefit. So if I'm paying 100 rupees interest, my expense is not 100. 100 into 1 minus tax rate is my expense, because whatever interest I pay, it is allowed as a deduction in income tax. It is allowed as a deduction in income tax. So interest after tax is equal to interest into 1 minus tax rate. Interest into 1 minus tax rate. Interest into 1 minus tax rate. Clear? Any doubts on this? Any doubts on whatever terms I've introduced till now? Coupon rate, face value, issue price, redemption value, interest in rupees, and interest after tax. Interest after tax. Any doubts on this? What is tax is already deductible? Correct. Later, leave it for the time being. It is a tax deductible item. I'll explain later. You are confusing. I'll see it later. Now, right below the table, cost of irredeemable debt. Cost of irredeemable debt. Now, the term irredeemable debt means there is no end to this. There is no end to this. So, irredeemable debt is like a perpetuity. Irredeemable debt is like a perpetuity. What is the formula to value perpetuity? There's a formula to value perpetuity. Present value of perpetuity is equal to, just give me a minute. Present value of perpetuity was perpetuity amount, rate of interest minus growth and all will not come. There's no concept of a growth rate in case of a debenture. You will pay the same amount every year. I take it to the other side. Rate of interest is equal to perpetuity amount divided by present value of perpetuity. Perpetuity amount is the interest I pay every year. Perpetuity amount is the interest I pay every year, and present value of perpetuity is today's value of the debenture. Today's value of the debenture. In a irredeemable debt, I will issue debenture today for 105 rupees or 110 or 100, whatever the price, and every year keep paying the same amount of interest. Keep paying the same amount of interest. There is no end. There is no end to an irredeemable debt. There is no end to an irredeemable debt, and that is why it's called as a perpetuity. That's why it's called as a perpetuity. So present value of perpetuity is equal to perpetuity amount divided by rate of interest. Rate of interest is technically called cost of debt. The short form is KD. Cost of debt is equal to perpetuity amount, which is technically interest after tax, divided by present value of perpetuity, which is today's value of the debenture. Present value means today's value of the debenture. Now write the formula. Interest after tax. I'll discuss on this after tax in some time. Interest after tax divided by net proceeds into 100 to express in percentage. Net proceeds is basically present value, today's value. Net proceeds is nothing but today's value. Interest after tax divided by net proceeds. I'll repeat again. The formula comes from this. Present value of perpetuity is equal to perpetuity amount divided by rate of interest. Rate of interest goes to the left hand side, which is the cost of debt. Perpetuity amount is the interest I pay every year, and present value of perpetuity is today's value, which is technically called net proceeds, which is technically called, what is net proceeds is the money which a company gets, the money which a company gets by issuing the debenture, the money which a company gets by issuing the debentures. Any doubts till this? Any doubts below this? Right? Net proceeds, net proceeds, formula 1 in bracket preferred, formula 1 preferred, issue price minus flotation cost, issue price minus flotation cost. Net proceeds means what do I get? Net proceeds means what do I get from the debenture holder? I'll get issue price minus the flotation cost. I'll get issue price minus the flotation cost. Formula 2. F1 is not to be used. If F1 is not to be used, write this, I'll explain both. Current market price. Current market price. Issue price minus flotation cost. I'll explain. Net proceeds basically mean what money do I get as a company. Interest after tax means what amount I pay every year. What amount I pay every year, and what amount do I get once. Only once I'll get, but every year I'll have to pay. If you issue debentures today, you will get issue price minus the flotation cost. You will get issue price minus the flotation cost. But what happened is debentures were issued 2-3 years back. Debentures were issued 2-3 years back. This cost of debt has to be calculated every year. It can change also. How it can change? Because see, when I issued the debentures, the interest rates in the economy were different. So people were okay with the 7% cost or 8% cost. Now the cost can undergo a change because people expectation changes. People expectation changes. Earlier I was paying 8%. Today RBI kept on increasing interest rates, because of which I don't pay a higher amount, but the cost can change. How does it change and all? You'll understand when I solve a question. But if debentures were issued 2-3 years back, today you cannot get any issue price minus flotation cost. Today you cannot get issue price minus flotation cost. So the concept is, if you were to issue the debentures today, if you were to issue the debentures today, you would have issued it at the current market price. You would have issued it at the current market price. So concept is very simple. First formula for net proceeds is what I can collect. Second, what I collect today. Second formula is, if you don't know what I collect today, what I could have collected today. What I could have collected today by issuing it at the current market price. By issuing it at the current market price. On top of current market price, there could be a flotation cost, but I cannot consider that because flotation cost was incurred some year back. Today I don't know what will be the flotation cost and all. What is flotation cost? Is cost which you incur when you issue any security. You could have come across terms like underwriting commission, terms like your issue expenses of prospectus. All that will come under the category of flotation cost. So two formula for net proceeds. First formula is issue price minus flotation cost. Second formula is current market price in case formula 1 is not to be used. In case formula 1 is not to be used. When it is not to be used, you'll understand as we do questions. Any doubts till now? Any doubts till now? Then write cost of redeemable debt. Cost of redeemable debt. This is irredeemable, which is a perpetuity. Cost of redeemable debt. Interest after tax. Average other cost divided by average funds employed into 100. Interest after tax, average other cost divided by average funds employed. I'll explain the formula, first note it down. Average other cost divided by average funds employed. Below that, average other cost is equal to, first complete all of this, then I'll explain. Average other cost is equal to redeemable value minus net proceeds divided by balance life. Just give me a minute. Net got disconnected. Okay, I resume. Redeemable value minus net proceeds by balance life. Average other cost, redeemable value minus net proceeds by balance life. I'll explain this in a minute. Then average funds employed. Average funds employed. Redeemable value plus net proceeds by 2. I'll explain these terms. Okay, let's understand both the terms. I issue debentures today. I issue debentures today. My collection today is 95 rupees. Today is 95 rupees. After 5 years, I'm going to redeem this for 105. Now, what for redeemable debt the formula says is, one, you have to pay interest. Which is after tax. What is after tax? We'll see as we do. Second is, you are paying extra 10 rupees. You're paying extra 10 rupees after 5 years. You're paying extra 10 rupees after how many years? 5 years. So every year you are indirectly paying extra 2 rupees. Every year you are indirectly paying extra. One is every year you have to pay interest. Second, every year indirectly you are paying 2 rupees. Indirectly you are paying 2 rupees extra. That is called average other cost. That's called average other cost. There can be a scenario where average other cost can be negative. That is, you issue at 105, redeem it at 95. Issue it at 105 and redeem it at 95, which is a rare scenario, but average other cost can be negative as well. What we are doing is, I issued it at 95, redeeming it at 105. So I'm paying extra 10 rupees. Sometimes I issue at 100, redeem at 100. I don't pay anything extra. Average other cost is 0. Concept is balance life in the denominator. Why balance life? For example, 2 years got over. 2 years got over, which means today you could have issued it at net proceeds. The formula says net proceeds. So assuming 1 year is over. Now I do calculation at the end of second year. The market price is 98. Ignore this data, okay? Market price is 98. Net proceeds is 105 minus 98 over the next 3 years. Over the next 3 years. Concept is balance life. Logic is today you can issue it at 98. Or from your point of view, you can buy the debenture for how much? 98. Redeem it at what? And earn average other income of 7 rupees. You can earn average other income and I can pay average other cost of 7 rupees over the next 3 years. So denominator is balance life. I am paying extra to you. Over a period of 5 years, 7 years, 3 years, 2 years. That's called average other cost. Denominator average funds is self-explanatory. Opening value plus closing value by 2. Opening value average. I'm taking average in the denominator for my calculation purpose, not the opening value, not the closing value. Take the average. Take the average, which is redeemable value, closing value, net proceeds, today's value divided by 2. Redeemable value plus net proceeds by 2. Any doubts on this? I'll repeat again. First is irredeemable debt, which is a perpetuity. Irredeemable debt is a perpetuity. Every year pay interest. On the interest save tax. That's why we call interest after tax. Divided by net proceeds. What I collect today or what I could have collected today. And for redeemable debt, Same logic, but there can be an average other cost. There can be an average other cost, and because you have an average other cost where you have an opening value and closing value, denominator says take average. Denominator says take average. This redeemable debt formula in bracket write approx formula, which is what we will use in many question. Approx formula. Exact answer, if you want, we'll have to do IRR technique. Exact answer is through IRR technique. How to do IRR and all I'll explain later, but exact is through IRR technique. Why in this no extra formula? Because irredeemable doesn't have an end. Irredeemable doesn't have an end, so this is directly the IRR formula. This formula which you see is directly the IRR formula. If you remember IRR, when you have a perpetuity, I had interchanged and gave the formula. This is the formula of IRR only. This is the formula of exact answer will come only through IRR technique. When I say IRR, what is the cost company is paying is one perspective. Second perspective is what is the investor earning? What is the investor earning? So investor's earning is called his IRR, and that's called my cost. That's technically called my cost. Clear? Any doubts on this? Any doubts till this?